We will take a clear, practical look at Danish R&D tax credits and what they can mean for your business. Denmark has deliberately designed its research and development incentives to support innovation, attract high-value activities, and strengthen the country's competitive position, but many companies still underutilize the available benefits. Our aim is to give you a concise overview of how the regime works, why it matters strategically, and what you should consider if you are planning or already conducting R&D activities in Denmark. We will focus on 3 key areas: the structure of the R&D tax credit, the financial and strategic benefits for businesses, and some practical considerations for implementation and compliance. To begin, it is important to clarify what qualifies as R&D in the Danish context. In line with international practice, eligible R&D typically involves systematic, investigative, or experimental activities aimed at generating new knowledge, products, processes, or services, or significantly improving existing ones. This can include basic research, applied research, and experimental development across sectors such as life sciences, technology, manufacturing, renewable energy, and digital services. Crucially, R&D is defined by the presence of technical or scientific uncertainty and the need to resolve that uncertainty through structured work. Routine activities, standard quality control, or cosmetic changes will not qualify. With that foundation in place, let us look at the core mechanics of the Danish R&D tax incentive. Denmark allows a super deduction for qualifying R&D expenses. In practice, this means that instead of deducting only 100% of your R&D costs, you may deduct a higher percentage when calculating taxable income, subject to specific rules and phased increases established by legislation. This enhanced deduction effectively reduces your corporate tax base and therefore lowers your tax bill. For loss-making or early-stage companies, a particularly valuable feature is the ability to obtain a cash refund of the tax value of certain R&D losses, up to a defined cap. This tax value of losses mechanism is designed to address the reality that many innovative companies, especially in technology and life sciences, may not generate taxable profits in their early years. Instead of waiting until profitability to realize the tax benefit, eligible companies can convert part of their R&D related tax loss into an immediate cash inflow. This can significantly improve cash flow, extend runway, and reduce funding pressure. For profitable companies, the primary benefit is a structural reduction in the effective cost of R&D. By allowing an enhanced deduction, the Danish regime lowers the post-tax cost of every krone invested in qualifying activities. When this is combined with Denmark's relatively competitive corporate tax environment, strong intellectual property infrastructure, and access to skilled talent, the net result is a more attractive location decision for R&D intensive functions. From a strategic perspective, Danish R&D tax credits can influence how companies design their operating models. Groups with activities across multiple jurisdictions may evaluate whether to place global or regional R&D hubs in Denmark, allocate specific development projects to Danish entities, or increase the scale of existing innovation centers. When assessing location options, businesses typically compare not only headline tax rates but also the breadth and stability of R&D incentives, the possibility of combining national benefits with EU or Nordic funding schemes, and the overall predictability of the regulatory environment. Denmark's framework is often viewed as transparent, rules-based, and relatively accessible, which can reduce compliance risk and administrative burden over time. Beyond pure tax savings, there are several broader benefits for businesses. First, R&D incentives can strengthen the internal business case for innovation investments. When project sponsors can demonstrate that a portion of costs will be effectively subsidized through tax relief or refunds, it becomes easier to secure board approval, especially for longer-term or higher-risk developments. Second, leveraging the R&D regime can improve reported performance metrics. By reducing tax expense or generating cash refunds, companies can enhance their net income, cash conversion, and return on invested capital, all else equal. This can be particularly relevant for listed companies or those preparing for capital raising. Third, for high-growth and venture-backed companies, Danish R&D incentives can form an important part of a broader funding strategy, complementing equity, grants, and debt, and thereby reducing dilution for existing shareholders. To unlock these benefits, however, companies need to approach R&D tax credits in a structured and disciplined way. The starting point is to identify which projects and activities qualify. This usually requires close collaboration between tax, finance, and technical teams. Technical leads must articulate the scientific or technological uncertainty, the hypotheses tested, and the systematic nature of the work, while finance and tax specialists map the underlying costs and ensure they are correctly classified. Eligible costs can include salaries of employees directly involved in R&D, certain external consultancy and subcontractor costs, materials and prototypes, and in some cases a portion of overheads that can be clearly linked to R&D activities, always subject to local rules and documentation standards. Robust documentation is essential. Danish authorities, like their counterparts across Europe, expect companies to be able to substantiate both the nature of their R&D and the associated costs. This typically means keeping contemporaneous records describing project objectives, milestones, experiments, failures, and outcomes, as well as time tracking or allocation keys that show how much effort each team member devoted to eligible work. Well-organized documentation not only supports the initial claim but can also significantly reduce the time and disruption associated with any subsequent review or audit. It is also important to integrate R&D tax considerations into your planning cycle rather than treating them as an afterthought at year-end. When new projects are proposed, decision-makers should consider from the outset whether they are likely to meet the criteria for R&D, how costs will be captured, and whether the structure of the project could be optimized to maximize eligibility. For multinational groups, this may include aligning intercompany arrangements so that the entity assuming R&D risk and owning resulting intellectual property is also positioned to claim the Danish incentives. Governance plays a key role. Many leading organizations establish a light but clear governance framework around R&D incentives, with defined roles and responsibilities, standardized templates for project descriptions, and periodic training for project managers and finance staff. Engaging with external advisors who are familiar with the Danish regime and current practice can also add value, particularly for complex projects, cross-border structures, or first-time claimants. As with any tax incentive, there are considerations and potential pitfalls. Overclaiming or misclassifying routine work as R&D can lead to disputes, clawbacks, and reputational risk. Conversely, underclaiming leaves money on the table and weakens the financial case for innovation. The challenge is to strike the right balance, being ambitious and thorough in identifying eligible activities, while remaining grounded in the legislation and guidance. Companies should also monitor policy developments, as governments periodically adjust incentive levels, thresholds, or administrative processes in response to economic conditions and competitive dynamics. In Denmark, such changes tend to be consultative and well signaled, but proactive monitoring remains advisable. For leadership teams, the question is not simply whether Danish R&D tax credits exist, but how effectively they are being used as part of a broader innovation and location strategy. If your organization is investing in new products, technologies, or processes in Denmark, it is worth asking 3 simple questions. Do we have a clear inventory of our R&D projects? Are we systematically capturing and documenting associated costs and activities? And are we fully leveraging the available incentives to improve our financial profile and reinvest in further innovation? If the answer to any of these is unclear, there may be material value at stake. In summary, Danish R&D tax credits offer a powerful combination of enhanced deductions and, for eligible companies, cash refunds of the tax value of R&D related losses. When managed well, these incentives can lower the effective cost of innovation, support cash flow, and make Denmark a more attractive base for high-value activities. By aligning technical, financial, and tax perspectives, strengthening documentation, and integrating R&D incentives into strategic planning, businesses can convert a policy tool into a tangible competitive advantage. For companies that are serious about innovation in Denmark, understanding and actively managing R&D tax credits should be a core element of their financial and operational agenda.